Hi, my name is Larry Sayler. Welcome to Accounting 101, Financial Accounting. I want to address two myths right up first before we start with Chapter 1. Myth 1, accounting is hard. No, I don't think it is. And I hope at the end of the semester you'll say it wasn't difficult. A lot of accounting is learning the terminology and learning the systems and the way people organize, accountants organize the data, but it's not difficult. I would especially urge you to do a lot of studying the first half of the semester. Well, the second half, of course, also, but the first half is going to be learning the terminology, learning how the accountants think. So that's going to take a little bit of time, but it's not difficult. Myth number 2, accounting uses a lot of math. No, we use some addition and subtraction, and we do that quite a bit, and occasionally some multiplication or division. If you happen to have a 7th grade younger brother or sister or a 7th grade child yourself, they can help you with the math, but I know you can do the addition and subtraction, get a calculator, have a calculator, and the math is not difficult. Sometimes we ask people to have had a math course before they do financial accounting, simply because math helps train you to think logically and trains you to think in an organized manner. But the math is not going to be difficult at all in this course. Now, Chapter 1 talks a lot about how transactions are organized. And there's a few phrases that we talk about. Assets. Assets are things that you own. Financial things that you own. Now, assets. Think about your assets. You're probably good looking. You're a wonderful son or daughter to your parent. If you've got children, you're a wonderful parent to your children. You help old ladies across the street. You may teach Sunday school class. All those things are your assets, but we don't care about any of those. We're looking at what is it financially you own. So if you were to be killed, I always say if I were to be killed in an auto accident this weekend, get hit by a car, run over by a car, what would my heirs be left with? And I think it's easy to start thinking about this from an individual's point of view as opposed to a business's point of view. So assets. What are your assets or my assets? Well, a checking account, a savings account, maybe a retirement plan. I've got some money in the college retirement plan, some money in investments outside the college retirement plan. I own a home, a car, I own a rental home. And I think that's about covers my financial assets. The other big term is liabilities. Liabilities, what you owe. So you may have a mortgage on your house. You may have an auto loan, you may have student loans. Hopefully you don't have any credit card debt, or at least you pay it off in full every month, so I don't really regard that as debt. But you have some liabilities. So assets and liabilities are two big words. Assets, simply what you own. Liabilities, what you owe. And if you think of assets and subtract your liabilities, for an individual we call that net worth. Take all your assets, subtract your liabilities, that's your net worth. A lot of people, when they're in their early 20s, have negative net worth. Their liabilities, for example, for student loans may exceed their assets. And yes, you can have negative liabilities. Negative net worth. So yes, and it's a good practice once a year to actually list your assets, your financial liabilities, and calculate your net worth. I do it every January as of December 31st. And I've been doing it for 30 years. And if you ever go to a financial counselor, they'll often ask you, they may not use the word assets and liabilities, but they'll say, before you come back next time, list everything you own and list everything you owe. And that's what they're getting at, your assets and liabilities. So assets minus liabilities equals your net worth. For a business, same concept, except instead of calling it net worth, it's called owner's equity. So we're going to assets minus liability equals owner's equity. Now, using 7th grade math, I think it's 7th grade math, I can't remember that long ago, but some simple algebra, we can add L to both sides, and assets equal liabilities plus owner's equity. So that's either one of these, they're the same equation, just written in two different formats. That's the fundamental equation of accounting. Assets equal liabilities plus owner's equity. For an individual, assets equal liabilities plus net worth. One time someone asked me, what happens if it doesn't balance? And this is the basis of a balance sheet. That's one of the terms you'll get used to, a financial statement, the balance sheet. Well, this is it's a plug number. It's the number that makes it balance. We calculate what that is and make it so it does balance. If assets were, for an organization, were 250,000 and liabilities were 100,000, then you say, well, 250 minus 100, owner's equity must be 150,000. So we back into that number and say, oh, by golly, it balances. But that's because we forced it to balance. It's a plug number. Don't tell the dean we use plug numbers. They think it's very complicated and hard, and that's why accountants often make good income, because other people don't understand it. But it really is simple. An owner's equity is just the residual. It's what you get when you subtract liabilities from assets. Two terms that we want to talk about within owner's equity: capital and drawing. Capital is an account, and it's used in Chapter 1 when the owner puts money into an organization. Drawing is used when an owner takes money out of an organization. So there's two things that make owner's equity go up when the owner puts money into an organization, and revenues. Both of those make owner's equity go up. Revenues are like sales. Two things make owner's equity go down. The value of the business is worth less when the owner takes money out of the organization, and also when you have expenses. Those are really the basics of a lot of Chapter 1. And thinking about a transaction, and if the owner puts $10,000 into the business, the asset cash goes up, and then the owner's equity goes up. The business is worth more by $10,000, and it goes in the capital account. So just like we talked about the types of assets and liabilities that an individual would have, an organization will have assets and liabilities. Cash, accounts receivable, that's a list of people who owe us money. Inventory, liabilities might be accounts payable. Those are a list of people we owe money to. Wages payable to employees. So a lot of Chapter 1 is just beginning to think in terms of this. Now, right at the beginning of Chapter 1, there's some initials that you ought to get familiar with. GAAP. I call these accounting alphabet soup. There's just all sorts of initials. GAAP, Generally Accepted Accounting Practices or Principles. Those are the rules that accountants have to follow. The rules are made by something called, and that's called GAAP. GAAP is referred to as GAAP. FASB, Financial Accounting Standards Board. They're the private organization that makes most of the rules. SEC, Securities Exchange Commission, the government that oversees accounting in the United States. And finally, the last one, SOX, S-O-X, Sarbanes-Oxley Act, was some major legislation that was passed several years ago, a dozen years ago. So read through the first part of the chapter. Get familiar with some of those things. CPA, I believe, is in there, Certified Public Accountant. Just get familiar with some of those things, and then begin to think about how accounts are structured and how you think about how transactions affect the various accounts. Good luck.